we're going to be talking about a trade called the bull. What is it? Well, it's a bullish vertical. It is a simple, non-subjective, somewhat bullish bias, high probability trading strategy on the Russell 2000. Bullish vertical entered at a specific time each month, and it's exited at either a specific time or when the position hits loss parameters. So unlike buying a stock where we might buy, say we were going to trade the Russell 2000. If we thought the Russell was going to go up, we would buy, you can't buy the Russell stock, but you can buy IWM, which is the exchange traded fund that tracks the Russell 2000. So it basically moves pretty much the same as the Russell, is just priced a lot lower. So I could buy IWM stock and make a bet that the market's going to go up and it's not going to come down. If I wanted to do something higher probability, I could sell a put that is what we call out of the money. And we're going to do this with the Russell. So say Russell's at 1,500 and I want to make a bet that the Russell's not going to come down a certain amount. I could sell a 1,450 put, and as long as the Russell didn't come down too much, that would make money. So I'm not betting on the price going up, and I'm not betting that it won't come down necessarily, because it can come down a certain amount of money and I can still make something. But I am kind of making a bet that it's not going to come down too far. So it gives me a very high probability of making money, higher than if I bought the stock, and that's why we do this. Okay, so we're not trying to time the market. We're not trying to be subjective. We're going to say, hey, this is the day that we enter. This is the day that we exit, unless, of course, we hit our loss parameters, in which case we may end up exiting early and then going to the next. So we'll give you examples of this. Why might somebody want to do a bull trade? Well, it's an opportunity for you to control your own finances. Realize that mutual funds, which is what most people use, they are generally difficult or slow to get out of. They often charge exuberant management fees. They take the hit of a full market decline, because for the most part, most funds, if the market goes down, they're not going to time and pull you out of it. They're going to allow the position to go down with the assumption the market's going to come back up. Usually they're right. Depending on what price you entered at determines how much money you lose, so it's highly timing dependent. So, if I had entered mutual funds in 2009, the middle of 2009, I'd be doing fantastic right now, because I would have made, I don't know, 12 to 20% a year pretty much every year, or 10 to 20% a year pretty much every year for quite some time. However, if I had entered in, say, early 2008 or late 2007, and we went through the 2008 market decline, I would not be back to normal. Assuming I stayed and held my stocks all the way down to the bottom and I didn't get out of the market, I would not be back to break even until sometime in 2011. So that's 2008, 2009. That's 4 years before you get back to break even, right? So to some extent, you're going to take that ride in mutual funds. And that's assuming they even did what the S&P 500 did. Because the reality is that the vast majority of professional mutual funds underperform the S&P 500 over extended periods of time, which basically means, the S&P 500 might make 10%, but your mutual fund is likely to make less than that, maybe 9, maybe 8, maybe 7. And from there, you have fees taken out of that, which is going to drop your returns even lower. So it is very costly, and returns tend to be quite low. Now, the bull trade itself, we, as well as the mutual funds, use the S&P 500 as a benchmark. And the bull has historically outperformed the benchmark virtually every year since 2002. Therefore, it outperforms a vast majority of mutual funds, and it also outperforms a vast majority of the much more complex, high probability strategies. The bull trade actually does very well against them most of the time. Something to think about. It's very simple, non-subjective, and it does extremely well. So it's a simple trade with simple management. There's essentially 2 trades per month on average. There's no adjustments, there is no subjectivity, and there's no analytical software needed. So, as you get going in this options trading profession and you start to get into complex positions, you're going to start to need analytical software, and that can be somewhat expensive, which is fine if you're trading with a lot of money, but trading smaller, then in other words, it can be problematic because it eats up some of your profits. So the good part about this, no analytical software needed. So how do we do it? Well, we have an entry. We're going to be looking at what we call 65 days to expiration. Depending on the software you're using and the platform you have, it might say 64 days to expiration, but essentially it's a Wednesday. Is it terribly important that you enter on a Wednesday? No, it doesn't really matter. It's just a consistent day to start with. So we have to have rules. We have to have guidelines. The guidelines that I'm using is going to be entering a holiday, and that's going to show up as 65 or 64 days to expiration. Our underlying asset, or the thing we're going to be doing the trade on, is the Russell 2000 Index, also known as RUT. We're going to exit when the back month is 65 days to expiration. What that means is, if I enter September at 64 days to expiration, I exit when October is 65 days to expiration. Depending on the length of the cycle, that's either going to be 37 or 30 days to expiration. The other reason I might enter is the position is down $250 per lot. My maximum anticipated loss, and I say anticipated on this for a reason, and we'll go over that, is minus $250 per one vertical. My maximum gain is also $250 per one vertical. Now that said, the anticipated loss essentially means that's where I'm going to start to initiate the exit of the trade. You can get drawn down more than that, and you can certainly lose more than that, but this is where we optimally would like to exit the position. My planned capital, or the amount of money that it's going to take, is per one vertical is going to be $3,000 minus the $250 credit I received from selling the vertical, which is going to be $2,750. The procedure for me doing that is I want to sell a 30-point wide bull put vertical that brings in at least $2.50 credit. This will typically result in selling a short strike of between 10 to 14 delta. So basically when we're selling our short strike in these, we're selling a put option at the strike of whatever has a delta number of minus 10 to minus 14. I'll show you where to see that in the broker platform. And we're buying whichever strike is 30 points below that. Again, we'll take a look at that, an example of that. So if my $250 maximum loss is reached in January before February 65 days to expiration, I go to the sidelines and I wait until 65 days to enter back into the market. Okay, so those are essentially the rules, and you'll understand them more and be able to come back to them after we do an example. So this is a trade, and with every trade you're ever going to do, it's going to have certain times when it does well. It's going to have certain times when it does poorly. In other words, you will lose. Over long periods of time, the strategy has a superior, excellent track record. We expect that track record to continue going forward. And there will be losing cycles. There will be losing periods. You're going to do well when the market's uptrending, when the market's sideways trending, and most of the time when with lower ATR environments. ATR stands for average true range, and average true range is how far up and down or what size are the moves every day. Am I getting an average of, a move of 5 points every day, or am I getting an average move of 50 points every day? Generally, in the most lower average true range environments, the bull trade is going to do fairly well. When is it going to do poorly? Well, it takes all its risk to the downside. You can have a fairly substantial down move and really not have a problem, as you'll see in this month's trade if we go to the coaching session here. But it's going to do poorly in very large down moves, particularly near entry. So one of the features of this trade is we put the trade on, and it has a stop out point where you exit the trade if the it gets drawn down a certain amount. So if you're down $250, you just exit it. Well, that point at which you're down $250 changes on the duration of the trade, and as the trade goes along, that move gets further and further down and further away. So large down moves near entry are going to be a little bit more problematic than large down moves maybe after an up move or after some time's gone by. If the market is strongly downtrending, like in 2008, it's going to lose. It's not going to take a strong downtrend. And also sometimes I have a very large average true range. The market's moving up, say it's going up 100 points in 5 days and then, down 100 points in 5 days. If I don't hit the right side of that, if I don't hit the trade or enter the trade when the market's down, and I'm likely to lose that position. So those are other times when it will be problematic. As far as trade size, always start small, right? Coming into this, presumably you don't really have any experience doing this. Start as small as you can until you've gained the experience. Never trade more than you can afford to lose. In this trade, expect to occasionally lose 2 times your maximum anticipated loss. So if I'm doing one contract and I have a profit target of $250 and a maximum anticipated loss of $250, I got to make sure I can afford to lose $500 without it really affecting anything in order to trade this. Okay, that would be trading responsible. Keeping in mind you could lose a little bit more than $500, but it would be highly unlikely if you're exiting the trade when you're supposed to. Minimum trade size on the Russell 2000 is $27.50. I'd recommend having at least $3,000 in the account to start this size, right? And then of course we talked about 2 times maximum loss. If you need to trade smaller, it can be done on IWM. So IWM is 1/10 the size of the Russell. So if Russell's at 1,000, IWM's at 100. If Russell's at 2,000, IWM's at 200. It pretty much tracks the Russell 2000. You put yourself in a position where you get 25 cents credit for doing the options, which would be $25. Basically, you get a $25 credit if you did what we call one contract or one lot. If I sold one vertical, then I would get 25-cent credit, and that would give me a $25 potential gain, a $25 maximum anticipated loss, and I'd only have $275 in the trade. If you do this and your broker charges you commissions, depending on what your commission rate is, you may not really expect to make any money. It's just kind of a practice thing so you can do it because your commissions, if they're high, will eat up $25 getting in and out of the trade, right? For a lot of us, Thinkorswim, I think they're going to charge new people $1.25 a contract. So that's 2 contracts in, 2 contracts out. That's 4 contracts. That's $4, about $5 in commissions. And you're probably not going to make $25. You might make 15. So that means you get $10 instead of closer to 15. Whereas if you're the bigger size of the Russell, your commission as compared to your position size is going to be a lot lower. And matter of fact, the commissions are almost negligible in the Russell doing this trade. But in the IWM, they do make a difference. There are platforms out there like Robinhood that allow you to trade options, and if you get the permissions, you should be able to trade this with no commissions, in which case it doesn't matter, right? You can do the IWM, but execution is important because it's a very small amount, right? A penny in execution is a big difference, where a penny in execution, the Russell's not a big deal. So there's disadvantages, but it is a good way to get going. It's a good way to gain confidence and deal with a very small position size if that's what you need to do. When we talk about trading the bull, let's look at the procedures for doing this, and then I'm going to show you. So I'm going to show you in words, and then I'll show what to do. So the first thing you need to do is you need to choose a checkpoint time of the day, a time of day that we call a checkpoint, because we don't want to be watching this all day long. That's not the point of doing this. It's a long-term trade, and and it should take a very short amount of time to monitor. You basically should be able to look at the market. You have to look at it daily, but you should be able to look at it and say, oh, the Russell is not down today. My position's fine. I don't worry about it. If the Russell is down substantially, you need to check your position. If it's a entry or exit day, you need to check your position. But whatever the checkpoint time of day is, generally I like it to be towards the end of the trading day, which in Eastern time is going to be somewhere around 3:30 or 3 o'clock. That's what I would like it to be. However, it could be any time of day, but it should be a time of day that you would generally be able to gain access to the market for 15 minutes to a half an hour if needed. Most days you don't have to do anything. Most days you look at the price of the asset, don't worry about it. But there are times when you need to do something, and you should be able to do that. To enter, when the Russell is 56 days to expiration, sell a 30-point wide bullish vertical. It's a put vertical that has close to but not less than $2.50 credit after execution during your checkpoint time. In other words, we want to get our $2.50. And we want that $2.50 to be present after all the execution costs have been done. If we don't get that, we go closer to the money. So let's take a look at that. Let me bring this up here. So this is my thinkorswim platform, and I'm just going to delete these for now. If I wanted to enter a bull trade today, well, let's first take a look at how many days to expiration we are. We go to our trade tab. We know it is Wednesday, but let me go to all products. I'll do the Russell. This is what it looks like. This is our monthly cycle right here. We're not 65 days to expiration. I think it'll show up as 64 in here. We're 57. So we're not at the right day. But if this was 64, 65, and it was Wednesday, we would come in here. And if you look up in here, you can change. I can put in here delta. So let me give myself more strikes. I give myself all the strikes. And I want to sell a put option. So this is the side of the puts, right? We have the calls, we have the puts. I want to sell a put option that has about minus 10 delta, which right now is, and I generally only use 10-point strikes. There's nothing wrong with using 5-point strikes. It is my preference. So I'm going to use 10-point strikes. I would sell, or I would look at selling the 1560 put option, and I would look at buying the option that's 30 points underneath, which is 1590. That is right here. Okay, and then I check the credit. So instead of looking at these as singles, I know the 1560 is a 10 delta. So let's go to this drop-down box and hit vertical. And what did I say? 1560. I can right-click this. I can sell a vertical. And I'm just going to pop this over to my Analyze screen by right-clicking it and hit Analyze Trade. This way I can see what my local graph says. Now, I accidentally did a call vertical. Well, that's not right. So I can click this drop-down box, no big deal. I hit Put Vertical. Now, I want to sell the 1560. I want to buy 30 points under that, which is 1530. Okay, that gives me a credit of $1.40. That is not nearly enough. Okay, and since it's not nearly enough, I'm going to go several strikes. So I'm going to go up to, let's go all the way to 1600. We'll see what we get. I go to 1600, and I go to 1570. This gives me a credit of $2.30. Still not enough. Let me go to 1610 and let's see, at 1580, right? That's minus 30. That gives me $2.60. This might or might not be enough, because it's where I'm going to start, because I get $2.60 credit after commissions. You know, I get $1. You know, let's just say I get $1 per option. That's $2 in commissions, which equates to 2 cents here, because this is times 100. This equates to 2 cents. So this is going to cost, you know, if I get the mid prices, I'll have a credit of $2.58. So that'll work. And that's how I would enter the position. So let me right-click this. If I wanted to try it mid-price, I hit confirm and send. It tells me, you verify you're doing the right thing. It tells me I'm selling a vertical, 1610, 1650. I'm getting $2.60 credit. It tells you my total risk and my margin, by the way, is $27.40. My maximum profit is $260. And of course, that is my maximum loss. It tells me my buying power effect is 27.4150, which is basically the 27.40 risk plus my commissions is going to be that. And let me send. And I go here to activity and positions. This is giving me a mid price of 265 right now. I have it in for 260. It's not giving me that money. Let's just let that sit for a little bit. We'll go back and talk about the rest of the trade, okay? So coming in here, that's my entry procedure, assuming I was 65 days expiration, which I'm not, okay? My exit procedure is going to go one of two ways. I'm either going to sit in the position until my next cycle is 65 days expiration, right? In which case the one I'm in will be 30 to 37 days. At which point I'm going to exit the position regardless of what my profit and loss is. I might be up money, I might be down money. It doesn't matter. I exit. I do my best on execution pricing and I record my results. The other reason I might exit would be is if I had a maximum acceptable loss. So if at the checkpoint time the trade is at or drawn down past the maximum acceptable loss number, exit the trade. So if I do one contract, my maximum acceptable loss number is $250. If I come in at my checkpoint time and I'm drawing down $260, I exit the trade. I close the position out. I lost. I wait till the next cycle, then I enter the trade. At the checkpoint time is the key phrase here. We're ignoring profit and loss outside our checkpoint time, even if it goes past our maximum acceptable loss before or after that time. So if I have a checkpoint time at 3 o'clock and my loss is $245, and earlier in the day it was 310, and maybe even after that the market went down some more and it was 275, we don't do anything because at the checkpoint time it was fine. Okay. Trade management and other notes. The base bull trade, which is what we're doing now, we'll call it the base bull trade or part one, has no subjectivity or bias. This means it doesn't matter what the charting is doing. It doesn't matter what the news is. It doesn't matter how we feel. We always, always, always follow the procedure. Will this always give you the best outcome? Short term. No, it will not. You'll have times when you say, geez, I knew I should have exited that trade yesterday, or I knew I shouldn't have gotten out of that trade, and because the market goes the other way or whatever, and it would have worked out, or the loss was lost. So you won't always get the best short-term outcome, but it is an extremely effective method long-term, and it will, over time, increase your win rate. So that is one thing. The other thing is we will look at adding a filter to this, and we'll look at adding a little subjectivity. So the base bull trade has no subjectivity. In part two, we're going to look at having some minimal subjectivity. Now the long-term performance of the trade, the bull trade here, we've back tested it, since 2002. We've traded it live for years, and the long-term performance depends on following the system. The system allows the trade to exceed maximum loss outside the checkpoint time. The system includes continuing to trade even when things aren't going well. So one of the problems people have with this is exiting the trade in the middle of the day because they're getting near their loss point. That is going to decrease your win rate. Another thing that happens is they get a bad month or 2 bad months or whatever, and so things aren't going well. All our past history, everything relies on us continuing to trade even when things aren't going well. So I've lost 3 trades in a row, I still go in the next trade, okay? Again, that's the long-term system if you're not subjective. When you enter the trade, you want to check it every day. at the checkpoint time. And always, always, always exit the trade if it's past your maximum acceptable loss at the checkpoint time. Don't think it's going to come back. It doesn't have to come back. The market can keep going down. You can lose everything. You can go in intending to win $250 and losing $2,750. That can absolutely happen if you don't get out of your position. If you go to get out of your position, that is not going to happen. But if you don't get out of it, that can happen. So it doesn't have to come back. So you always want to check that at the checkpoint time. But at the same time, do not watch the position outside the checkpoint time. You're not going to do anything there, so it doesn't matter, right? Have the attitude that nothing outside that time matters, and you'll do fine over long periods of time trading this strategy. It's a very, very good strategy, okay? So let's just quickly look at the position here. It's now showing me, now it's 260, 265 mid. Just kind of bouncing between there. It's just not filling me. So what I can do here is I can cancel replace order. I can come into here and I can drop down, say 2 cents. I confirm and send it. And there it goes, right? So I filled at 258. If you add the commissions onto that, I think it's there, just say they're $2. I would have a $256 credit coming into this. So if I hit the analyze screen, so I can go to monitor, I can right click this, I can analyze trade, and this is the position. It's down a little bit of money because of commissions and because of mid price, and also my date's off. So that's another thing to watch with this. Your date can be off, and that's going to affect what this line is, because this pink line's a projection, right? So I have to come to today, which is the 19th, and it's showing me down. And over time, this pink line migrates toward the blue line. As long as I don't come down too far, then I make money, or I don't lose, or I don't get stopped out. Right? I could come down into here and have to exit by date and lose maybe $100 or something like that. But more than likely, we're going to end up with the market higher, and we'll probably make money with this. So I'm also going to save this as a trade. So what I can do is I can click here and put export all trades. I have to go to, that'll bring a box that looks like this, and I navigate to where I want to go, and then I need to name the trade. I can make folders, right? This is in a folder called Toss Trades 2018, 2018-11, because it's an 11, it's a November expiration trade, and this is going to be a FIT trade because it's in the FIT program. This is going to be the November. And I don't know if this is going to win or lose, right? But it's going to be it's not the November bull, but it's the November lesson example. And we'll see how this does on our next lesson. Let me save. All right, so our next lesson, when it comes in, we're going to do a quick review here of lesson 1. We're going to talk about the bull trade in part 2, and we're going to talk about setting up and interpreting bear market filters and setting up automatic orders, timing entries, and exits. All right, thank you for joining me here.